Our session is on capital expenditure risk analysis. Here we extend our investment decision analysis to accommodate the fact that when we evaluate a new business opportunity, we do not really know with certainty what the cash flows will be in the future. Firms and individual investors understand that cash flow projections are estimates, ideally based on solid market and production research, but they are estimates nonetheless. So firms and individual investors usually want information not only about the likely result of an investment, that is the likely net present value, but also about how bad or good the result might be, and on what the result might depend, that is on what variables the result might depend. We cover 5 topics in risk analysis: sensitivity analysis, break-even analysis, scenario analysis, Monte Carlo simulation, and real options and decision trees. Sensitivity analysis is a risk analysis technique that asks the question, what happens to net present value if our projections about a single variable are not accurate? All of our risk analysis techniques start at the same place. We determine the most likely values for variables that determine net present value, and these variables are the cash inflow and cash outflow determinants. And then we calculate net present value. Then we identify potential sources of variability in cash inflow and cash outflow. Next, we check the sensitivity of net present value to changes in each variable individually. I'm going to show you how to use a single spreadsheet, how to use the data table function to do sensitivity analyses quickly, and how to use line plots to identify which variables generate the most sensitivity of net present value. And then we're going to use our data to identify the break-even value for each variable. Let's take the example of Obate Company's motor scooter project in Chapter 10 of the text. First, we'll identify and solve for the base or most likely case net present value. Then we'll identify sources of variability in cash inflows and cash outflows that might affect NPV. In the example, the sources of variability that we'll look at are volume, as determined by market size and market share, price at which we can sell the motor scooters, and our cost function, as described or identified by average variable cost and fixed cost. I've copied the information for Obate's scooter project into our Excel file. I've labeled this worksheet Likely Scenario because we're going to use this worksheet to calculate the net present value of the most likely case. In the upper left corner of the worksheet, I've entered the variables that are likely to determine the net present value of this business opportunity. They are market size, market share, price per scooter, average variable cost per scooter, fixed cost, the tax rate in Japan, and the cost of capital or discount rate. In column B, I've indicated the base or likely case values for each of these variables. As you can see, I've set up our cash flow analysis using the income statement format. where we have revenue, three cost components, pre-tax profit, taxes, and profit after taxes. It's important to set up your cash flow analysis with cell references to these variables, which might change in our various risk analyses. So for example, revenue is given as a function of market size, market share, and price. And here we have revenues of 37.5 yen. Variable costs also depend on market size and market share, and average variable cost as well. Notice we use cell references to determine the total variable cost in the year. Depreciation expense was calculated using straight line depreciation. Our investment is 15 yen, so 15 divided by 10 gives us 1.5 yen in depreciation expense per year. Our pre-tax profit is the difference between revenues and our three expense components, and in each year it's 3 yen. Our taxes are 50% of our pre-tax profits. Net profit after taxes then is equal to pre-tax profit minus taxes. And finally and importantly, net cash flow is equal to profit after taxes, adding back in depreciation, which is a non-cash expense. So we have net cash flow in year 1, and in fact in every year out to year 10, which is the term of the project, of 3 yen. Here I've calculated the net present value of this new business opportunity, the motor scooter opportunity, under the likely scenario that's defined by these values for the parameters that determine net present value. In this part of the worksheet, I've created a sensitivity analysis table that shows the sensitivity of net present value to 3 key parameters: price, market share, and average variable cost. As you can see, this sensitivity analysis table provides a lot of information to decision makers. Now I want to show you how to create a sensitivity analysis table fairly quickly and easily. I'm going to concentrate my presentation on creating an analysis of the sensitivity of net present value to the price of a scooter. The first step is to create a column that indicates the price levels that you want to include in the sensitivity analysis. I recommend creating the values in the price column using a column that indicates the percentage difference from the base price that the prices can take on. Our base price is 375 yen, as you can see here. I'm going to allow the price per scooter to vary over a range of plus to minus 30% difference from our base price of 375 yen. So to create the values in this column, the first thing to do is to write in the 375 yen as the base price. And you need to type that in as a hard number. Don't use a cell reference. Then you go up to the top of the column and create a formula for the price that's 30% higher than the base price. And you can see my formula, and I'll let you work with it on your own. Once you have that formula and use proper anchoring of cell references, you can drag that formula down and fill in this column. Once we have the price column filled in, the next step is to indicate the net present value of the base case in this cell. In order to do that, let me delete it here and show you how to do that. We say equals, and then highlight the cell that includes the base case NPV calculation, and say enter. So now we have the net present value of the base case entered at the top of this NPV column. The next step in creating the sensitivity analysis table is to use the data table function to fill in the values for the net present values at these various prices. Let me delete these values that I've already created and now show you how to use the data table function. First, we want to highlight the cells that include the price range that we're interested in, that include the net present value at the top of the NPV column, and that include the cells where we want the net present values to appear. We go up to the top where it says Data, click Data, scroll down to Table, and here we have the arguments in the data table function. The data table function gives you two choices, a row input cell or a column input cell. Since we are putting our net present value calculations into a column, and since we have our prices, our various price levels in a column as well, we're going to click the argument that says column input cell. Then we go over to our worksheet and click on the cell that indicates the price per unit base case. We say OK, and we fill in our sensitivity analysis table. So using the data table function, we can create a table that shows the sensitivity of net present value to price for our motor scooter project. We can do it quickly and easily and thereby provide a lot of information. We would interpret the results of our analysis as if we allow prices to range plus or minus 30% from the base $375, we are going to see a range of net present value results that go from 38 yen to minus 31 yen with a base result of 3.43 yen. You can check on your own how I did the sensitivity analysis for market share and the sensitivity analysis for average variable cost as well. What I want you to note is that for all three of these key variables, I've used a range of plus or minus 30% from the base value. In doing that, I've enabled us to see the relative sensitivity of net present value to changes in these three variables. You can see that we get a wider range or more sensitivity of net present value to changes in price than we do to changes in market share or even changes in average variable cost. Perhaps to see more easily the relative sensitivity of net present value to changes in these three variables, you can create a graph that indicates how net present value changes with changes in each of these variables. The slopes of the lines here indicate the relative sensitivity of net present value to each of these variables. So you can see steeper slopes indicate more sensitivity. you might be able to see that the steepest line in the graph is this pink line, which indicates that net present value is most sensitive to changes in price. The line with the second steepest slope is this brown line, indicating that NPV is next most sensitive to changes in average variable cost. The line with the gentlest slope is that indicating sensitivity to market share. There are several ways that the firm can use the information provided by sensitivity analysis. First, if we know that the success of the project is most highly dependent on price, we might want to make sure that our base case estimate of price is correct. That is to say, prior to embarking on the investment in the motor scooter project, we might want to do additional market analysis to make sure that this number is the correct number and to get a sense of just how reliable that number is, how much variability there might be around the price of 375 yen. Second, if we decide to make this investment in the motor scooter project, we know that success depends most importantly on achieving our target price. Therefore, in terms of implementation of this project, we're going to want to make sure to devote sufficient resources to marketing so that we can sell at least 375 yen. To give the firm one more bit of information about how NPV depends on its estimates of key variables, we can conduct break-even analysis, which determines the value that must be achieved for each key variable so that NPV is 0. We can get a sense of the break-even points for the key variables by looking at our sensitivity analysis graph. Net present value is given along this line in the graph. As you can see, the pink line for price crosses the 0 NPV axis right about at minus 7%. This means that as long as price doesn't fall by more than 7% below the base price, we'll have a positive net present value. For market share, we see that this light blue line crosses the axis right about at, let's say, minus 16%. The inference here is that as long as market share does not fall more than 16% below our base amount, we'll have a positive NPV. We can solve for the break-even point for a key parameter using the solver facility in Excel. So let's go up to the top, click Tools, scroll down to Solver. Click Solver, and we have a Solver Parameters dialog box. To use Solver, we need 3 key parameters. The first is the target cell, or the cell that contains the net present value. I've copied the NPV function from our base case analysis over into this cell, L17, just for convenience of using Solver. Second parameter is we need to say that we want to set net present value equal to a value of 0. And the third parameter is to indicate the cell where the values are going to change so as to achieve an NPV of 0. And that cell is cell B7, which is the price. So we have all of our parameters correctly specified, and we hit solve. In so doing, we've changed the spreadsheet here, the cash flow spreadsheet. Notice that our net present value is now 0. What has changed over here in our list of variables is only the price per unit. And you can see that if the price per unit is 364 yen, then what changes is our revenues and nothing else about our expenses. Our profit has changed, our cash flow has changed, and our net present value has fallen to 0. So what the solver facility has done for us is to determine the minimum price that we can receive for our scooters so as to at least to break even in a net present value sense. Once we've determined the break-even price, I like to go back and hit this Restore Original Values button so that we get our spreadsheet, our cash flow analysis back to the original shape. But we know that our break-even price is 364. Another valuable risk analysis technique is scenario analysis. Scenario analysis allows for the changing of several variables at once. The idea behind scenario analysis is that if the market goes bad or the world turns bad, a lot of the variables that determine net present value are going to go bad together. Or if the market turns good, the world turns good, a lot of the variables that determine NPV will all turn positive together. The steps in scenario analysis are first to identify sources of variability in cash inflow and cash outflow. That is, to determine the variables that come together to establish cash inflow and cash outflow, and to think about how they might change. Second, using these variables, we want to establish a likely or base case scenario. We want to establish a bad case scenario where these variables all kind of go to a bad level. Sometimes we want to establish a good case scenario. And we want to do this analysis, these analyses of likely, bad, and good case, using separate spreadsheets. Then we want to check the sensitivity of net present value to these scenarios. Back to our Obate scooter example. This sheet, again, we labeled previously likely scenario, and you can see if we establish these variables at their likely values, we achieve a net present value of 3.43 yen. So we have already established the net present value of the likely scenario. Now let's establish the net present value of a bad case scenario. We can take this likely or base case scenario and amend it to create a bad case scenario and calculate an NPV for a bad case. The easiest way to do that is to copy this whole worksheet. So go up to the northwest corner and click, and then just go up to the top and say copy. Scoot over to a new worksheet, which I've already labeled Obate Bad Case. Go up to cell A1 and hit paste. So what we've done is simply to paste the likely scenario values and the cash flow analysis and even the net present value into a new worksheet. To define the bad case, I'm going to use the high oil prices and recession case that's given in Chapter 10 of the text. The values in that case are a market size of 0.8 million, a market share that's actually increased for Obite to 13%, a price that, in the case in the text, actually rises, but I'm going to leave at 375 yen, average variable cost of 345 yen, fixed cost of 3.5, and the same tax rate and discount rate. And let's now go up and label this bad scenario. You can see that because we established our base case or likely case scenario using cell references, when we copied over to this spreadsheet and created our bad scenario, and the values in the cells changed, our cash flow analyses adjusted immediately so that we have new revenues, new costs, new profit, and then new net cash flow values, and our net present value has even adjusted. In this bad scenario, the net present value has fallen from over 3 to now a negative 11.56. So the information provided in this scenario analysis is that if the world really turns bad for Obite, so that market size falls and costs rise, Obite will lose a considerable amount of money on this investment. That's essentially the purpose of scenario analysis, is to lay out what if several of the variables that determine net present value actually turn bad altogether because the world changes considerably from what we expected it to be. How much money would we lose under a bad case? As you can see, if you set up your analysis properly, creating scenarios is really quite easy. The difficult part in scenario analysis is in coming up with good estimates of the values for these variables under each scenario. Many financial analysts do scenario analyses on likely and bad cases and then stop. But some financial analysts like to extend their scenario analysis to inform risk understanding further. The process they follow is to establish net present value amounts for likely good and bad cases, and then to assign probabilities to these cases and calculate an expected or average net present value across the three scenarios, the standard deviation of the net present value across these scenarios, and the coefficient of variation of net present value. We can use this sheet to see how to extend scenario analysis to the determination of an expected net present value across multiple scenarios. The analysis here concerns the acquisition of an MRI machine by a hospital. We've already mapped out the bad case, expected case, and good case scenarios defined by volume and salvage value of the machine. And we've calculated the net present values for each of the scenarios. So for the bad case, we have a loss of $820,000. The expected case has a gain of $182,000, and the good case has a gain of $984,000. To calculate the expected net present value, we need to assign probabilities to the occurrence of each of these cases. Assigning these probabilities sometimes amounts to more art than science. What I've done here is to assign a 60% probability to the occurrence of the expected case, a 20% probability to the occurrence of the bad case, and a 20% probability to the occurrence of the good case. Given those probabilities and these net present values, we can calculate the weighted average of these NPVs using these weights, and that becomes our expected net present value. So for this business opportunity, the expected net present value is $142,000. The most likely result, or most likely case, gives us $182,000. We have a difference between the expected NPV and the likely case result that is determined by the spread of the good and bad case scenario values, or scenario NPVs. In addition to giving us the expected net present value, this analysis can also give us a sense of the risk that we face in adopting this new business line. Financial economists typically use standard deviation as a measure of risk. So we can calculate the standard deviation of these net present value amounts using this formula. And I'll let you go through the formula on your own if you're interested. But what we get is a standard deviation of NPV of $572,000 and an expected NPV of $142,000. The ratio of standard deviation to expected is defined as the coefficient of variation. Now, once again, some financial economists like to use coefficient of variation as an indication of relative risk. So if we have a big standard deviation relative to a particular expected value, then our coefficient of variation will be high, and that'll indicate a high degree of relative risk. As a final step in scenario analysis, some financial analysts like to take the information provided by the coefficient of variation and use it to adjust the discount rate that they apply to the cash flow analysis of a project for the relative risk information that's provided in the coefficient of variation. In doing so, they're applying what's called a risk-adjusted discount rate. We'll come back to the determination of risk-adjusted discount rates later on in the course. Before we conclude this session, I want to introduce briefly two additional risk analysis techniques. The first is Monte Carlo simulation, which can be thought of as essentially a really sophisticated version of scenario analysis. In Monte Carlo simulation, we might start the same way we did with scenario analysis. That is, we would start with a base case. So we model the project with a set of base case assumptions about volume, price, and cost. But instead of specifying, let's say, a variable such as volume as a fixed amount, we specify volume as a variable with a probability distribution. So we might say volume has an expected value of 100 and a standard deviation of 30. Once we've established the probability distributions for the key variables that might influence NPV, we proceed to step 3, which is to simulate the cash flows. Now, what Monte Carlo simulation does is it kind of allows for the running of 1,000 scenarios really quickly, and then we for each scenario, a net present value is calculated. Here's one of the results or outputs of Monte Carlo simulation. This graph shows the probability distribution of cash flow in year 10 of our motor scooter project. You could also get the result, the probability distribution for the net present value of the project overall. And that result would indicate to you the likelihood of a positive net present value or a negative net present value. Some of you may encounter Monte Carlo simulation analysis of capital expenditure proposals in your organizations. And I would just refer you to the text which describes the conduct of simulation analyses more fully. The last decision analysis technique in this session is the use of decision trees, which is related to the concept of real options. A decision tree is a diagram of sequential decisions and possible outcomes. Decision trees are used to help companies think about the fact that every decision they make affects the options that are available to them in the future. So decision trees help companies identify their options and actually think about the consequences of those options and the values of those options. Any decision that creates an option to avoid a loss or produce extra profit has value. And therefore, the ability to create an option has value, and that ability can be bought or sold. Here we have a representation of a decision tree. The decision tree is typically mapped out by decision points, represented here by cubes, and sometimes by result points, represented here by a cylinder. The situation that's represented here is the decision to test a new product, let's say a new drug compound. The firm is at this point and is deciding whether to test the new drug compound, which will cost the firm $200,000, or not to test the new compound, which will cost the firm nothing. So the choice don't test has a net present value of 0. The choice test puts us on this path and requires a $200,000 investment. Now, if the test is successful, the firm is able to pursue a project with a $2 million net present value. If the test is unsuccessful, the firm is unable to pursue the project, will stop the project, and will have a net present value of minus $200,000. If we were able, back at this point, to assign probabilities to success and failure, we would be able to calculate an expected net present value associated with the choice of testing now. We know the net present value associated with the choice of not testing is 0. And it may be that the net present value, expected net present value associated with the choice of testing is significantly higher than 0, or it could be negative. The essence of using decision trees is to identify the options that are created by various decisions that the firm might make and the values of those options.